Well, hello and welcome to our show today. I have a very, very special guest. I'm sure you have heard about Matt Faircloth. Matt is the founder of the DeRosa Group, transforming lives through real estate. He has also written the book on raising private capital, available on biggerpockets.com and on Amazon. I personally have read that book and I will highly recommend it.
Thank you. Thank you so much, Raj. It's such an honor to be here.
I don't know if you remember, but very beginning, you told me that, Raj, if you want to grow and scale and do it in a sustainable manner, what you got to do is you got to double the size of your portfolio with every purchase.
Yeah.
And I've used that in the past, and I plan to use that in the future. That is solid advice.
Yeah, it's solid for everybody, and it's not as sexy to oh, well, you want to go out and buy a single family home, and then but look at like how quickly things scale, right? So you buy a 1, and you buy 2, and then you buy 4, then you buy 8, then you buy 16, then you buy 32, and your learning curve increases so quickly. That's what I did. That's what you did. And I think you would testify that, like, at the end of the day, your learning curve and your exposure and your capacity to do the deal increases as you go. And and as I know from your story, you've been able to retain more equity for yourself in increasing that way versus
Correct.
Like someone, no offense, who took a run to the back of the room guru class that taught him how to go out and buy a 100-unit apartment building day one with no experience. They're going to have to sell their soul to their investors on that first deal because they've got no experience, and that deal can eat them alive 5 different ways.
Could you tell us a little bit about your journey? How did you get started in this business? And tell us about your success along the way.
Sure. Well, there's a lot of successes, a lot of failures, a lot of roller coaster rides, Raj. I've been doing this for 15 years straight, so I've learned a lot about real estate. I've gotten, it's given me a lot of gray hairs and a few bags under my eyes, but at the end of the day, it's been a phenomenal business that I'm grateful to be a part of. I got started full-time 15 years ago, but the really story goes back before that when I met my wife, girlfriend at the time. She got me to read a little purple book by a guy named Robert Kiyosaki called Rich Dad, Poor Dad. And I was a traveling sales rep at the time, made a good living, made good money and everything like that. But I wanted something more, but I wasn't sure what something more was. I was thinking about quitting my job and becoming a teacher, wanted to inspire other people, wanted to just make a difference more than I was as just a sales rep. And so I was looking at other alternatives for life. And she got me to read Rich Dad, Poor Dad, and it just popped. It was a popcorn kernel unpopped, and then I popped. Like, okay, I get it, And so I bought a single family home, rented out 2 bedrooms to 2 of my buddies, lived in the house myself, ended up making some money and living there for free. And then really drank the Kool-Aid from there. My wife and I, still girlfriends, started buying rental properties around Philadelphia. And then I quit, and we took it from there and started the DeRosa Group. We did mostly small stuff for years, Raj. We did single family homes. We did, duplexes, triplexes, quads, and then scaled up into office buildings and mixed-use buildings and stuff like that over time. But really didn't start raising capital until we were in the game for about 5 or 6 years. Then we started raising private money, and we were able to build our portfolio very quickly. Once we had gotten the battle scars of doing it ourselves with our own money, we grew quickly with other people's money once we had kind of proven the concept. I've been using other people's money for about 9 years now, and I'm proud to say that we manage somewhere in the neighborhood of about $15 million worth of other people's capital spread out around, say, $40 million worth of real estate in 4 states of the union right now. And we just got approved to buy another $18.5 million in North Carolina, so that'll take our portfolio holdings up just around $60 million, which is really exciting.
Sounds exciting. Could you tell us a little bit more about the North Carolina deal?
So this is my second deal in North Carolina. I love the state of North Carolina, voted by Forbes magazine as the most business-friendly state in the union. North Carolina real estate is on the rise because North Carolina is a friendly state to do business in. Other companies that employ people are moving there, right? Banks are moving there. Manufacturing operations are moving to both Carolinas. We love both Carolinas as places to invest. The cost to buy, if you buy in the big cores like Raleigh and Charlotte, you may be late to the game because those cities have already popped per se from price-wise because they've already made the radar. We tend to not play in the A markets that have already popped. I don't want to pay somebody else's appreciation. I want to have my own blood, sweat, and tears be what increases the value of property. And so we play in B-level and tertiary markets in North Carolina because we can buy at a discount people still get employed. There are still jobs. There are still opportunities to be made in B and C level markets. So we own 198 units in Fayetteville, North Carolina, which is the home of Fort Bragg, the largest military installation in the world. And we're about to buy 336 units in Winston-Salem, North Carolina, which is the home of all kinds of different companies like RJ Reynolds, tobacco manufacturer. I get it. Shame, shame, shame. But there's also lots of banks there. There's also Wake Forest University. There's also many, many other corporations and entities that are there in the Winston-Salem, in what you call the Piedmont Triad, which is Greensboro, Winston-Salem, and High Point. They're all commutable to each other in that. So we're really excited about this deal just outside of downtown Winston-Salem. Going to be a phenomenal opportunity for those that are accredited investors are more than welcome to join us on that deal.
That's fantastic. And if they want to look up this deal and look for ways to invest with you, they just go to your website?
Sure. Just go to DeRosaGroup.com. It all starts there. Just go to DeRosaGroup.com. You want to join our insiders community, which will cost you more. It'll cost you less than what you pay for coffee each month, and you'll get tons of real estate inspiration and private brain picking sessions with me. You can get to that by going to DeRosaGroup.com/insiders, or you can go to DeRosaGroup.com/invest to hear more about investing with us and get vetted through the process that it takes to become approved as one of our investors.
If you have to kind of distill your life lessons and say, if there are 3 or 4 things that I could tell you to become successful, what would that be?
I love that. It's a great question. These are the 3 things I've learned. And I was sitting with another entrepreneur friend of mine over a beer one time, and this just kind of came out of our mouths. Successful entrepreneurs don't quit, right? There will be many opportunities that this business will give you to quit. As you know already, you're a seasoned real estate investor too now. This business can bite back and can push back and can hit back very hard, right? It is a tough business. It's very rewarding, but it is tough, right? Yet there will be phenomenal opportunities to quit this business and to get out and to cut bait and to get out and go do something else. Like, I'm just going to go back to my job. Forget it, right? Don't quit. Successful people don't quit. Failure is just quitting. Failure is just refusing to try again. That's what failure is. Many, many successful people, including Abraham Lincoln. Look at Abraham Lincoln's life history. He lost his entire life, and then he got elected president. Like he tried and tried, just kept going until he won, right? That's number 1. Success is just not quitting. Number 2 is do not let your emotions get involved. And what I mean by that is real estate there's lots of zeros and lots of dollars and cents involved in real estate, and you can get your emotions caught up in a deal. But if you are disciplined with your emotions and use them as more of a guide and a course corrector versus being controlled by them, getting angry at a tenant that doesn't pay their rent, getting overly excited about a potential deal that you have and maybe overpaying for it, getting upset when a business transaction doesn't work out well. Your emotions will absolutely cause you to make the wrong decisions in this business. And this business should be something that's very pragmatic, straightforward, go, 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 go. But if you do not let your emotions get involved, that's number 2. Your emotions can be toxic in real estate. Number 3, keep moving. Again, and I've made all 3 of these mistakes, that's why I know that they work. The third thing is, like I said, keep moving. And momentum is what really works in real estate. Real estate's actually a slow moving vehicle. It's not like trading Microsoft stock. You can't day trade real estate. So to grow a real estate portfolio, you've got to continually be moving, thinking about what's next, and constantly be solving problems and putting in implementation systems to prevent those problems from happening again, and take steps. If you get stagnant in real estate will get, it can really slow you down, and you will not keep up with the marketplace, and you just won't keep up. So real estate is something that you've got to continue to put one foot in front of the other and move into, right? So those are my 3, I think, call them keys to success for real estate investing. And if you can do all 3 of those, I think you're going to be successful. But most importantly, above all of them, is the first one. Don't quit.
All right. Don't quit. Don't get emotional, and keep moving.
Yep.
Wonderful.
They sound basic. They're very easy to break. But if you live by those 3 rules, I think that you'll do very well.
Question 101 about real estate syndication is, what is real estate syndication? How is it different from buying investment properties on my own?
It's a good question. And like, you also deal with, like, why would I give, Matt Faircloth and Raj the money, right? Why wouldn't I just go and buy a duplex, right?
Right.
Well, that's a good question. So let's answer the first one, which is, what is a syndication? A syndication, the definition of the word syndication is just a group of people doing something as a collective that will be hard or impossible for one of those groups to do by themselves, right? So that could mean a syndication could be a bunch of guys building a house, you know. Well, one person can't do that, you know. It's a bunch of people doing something collectively, typically a financial activity. So that's all it is. A syndication has evolved to mean a syndicator, you know, you or me, organizing a group of passive investors to put up the money while you and I put up sweat, you know. So you and I put in sweat. The again, my book, Raising Private Capital, I just have to mention it because it's a good transition pointer. It's a good my book explains a lot of this. But there are
Yes.
two people in real estate investing. There are deal providers, that's you and me,
Mhm.
those that go out and leverage our contacts and leverage our people and leverage our real estate knowledge and leverage everything that we know. And then there are cash providers. Those are folks that don't want to put in the time, that want to be passive, but want to have their money go to work for them, right? The deal provider and the cash provider bring equal value pieces to the table, and they go off and do a deal, right? That's a syndication. Now, why would someone invest in a syndication? I kind of highlighted it right there, and that is that what they're foregoing is the obligation for them to put their time into the project, right? At the end of the day, there is one limited resource in the world. I'm a prosperous, abundant mentality person. I believe that there is unlimited amount of money for me to have access to. There's unlimited amount of resources and deals and people and contacts and stuff that I can use. It's unlimited well of opportunity for me. The one limited resource in the entire world is time, right? The one thing that there's only but so much of. And so if I'm an investor and I want to make money, I either have to put my time up to make my returns. So I want to make 18% on my money. I want to make 15%, 10%, whatever it is. I have to put my time in to manifest that return for myself, or I have to leverage someone else's time and be okay with them taking some ownership and some compensation for their time. If I don't want to pay a syndicator a slice of the deal, a slice of the project and profit or fees or whatever it is, then I should just go do it myself. And I think that's when that is one of the things that you got to have the courage to do as someone who's organizing these types of deals, is when investors start pushing back and saying, well, why are you taking this fee? How much is your carve out? How much is your equity split? How much is this? How much is that? You know,
Yeah.
you might be better off going and buying a duplex, you know, or going and taking your 50 grand and going and investing in something that you can control, because you're going to make a higher return. But what you are going to have to do is you're going to have to inject your time, even if you hire a property manager. Because as you and I know, Raj, you know, right? Property managers do but so much, but you have to manage them. You have to manage the manager. And those that buy real estate thinking that they can just hire a property manager and go like this and go sip Mai Tais on the beach are going to have a rude awakening at some point and realize that, hey, that property manager didn't do everything. They only did this much. They didn't do everything that needs to happen. Am I right?
Yeah, absolutely. And there is a huge learning curve in the beginning. Could you tell us a little bit about the risks associated for the LPs? Is it 100% safe? Will they definitely make money? Will it never go wrong?
No, you hear lots of stories of LPs. I mean, that lose their money. I mean, look at, you know, Bernie Madoff had LPs. Those were his limited partner investors, man. I mean, it's really all about the operator you invest with as an LP. That's the biggest risk you take, is the operator either truly being a bad actor, or the operator just not being able to prop the property up and squeeze profit out of it, you know, over time, right? That's the biggest risk you take, is the operator either doesn't know what they're doing or makes mistakes with your money, right? The second risk that an LP takes is that, I mean, and this is kind of in line with the first one, but you're out of control. So yes, you give up time, but because you give up time, you give up control, right? And so an LP can't call the property manager and say, hey, how come collections are low? Or why haven't you leased out that apartment in 3 months? You know, it's the syndicator's job to do that. And the LP, although they have very little risk exposure, they have extremely low control on the deal, right? So that's the risk reward thing for LPs. Yeah, and then that, you know, obviously market related risk too, in that, you know, at the end of the day, maybe properties may go down in value because the market may change, or you might invest in Houston, Texas, and then a hurricane comes through or something like that, or you might invest in areas that are prone to whatever natural disasters, or, you know, invest in a small town and the local employer pulls out and the whole town economic structure drops or something like that. These things these are risks that happen too, but those aren't limited to LPs. That could happen to any real estate investor. But the biggest thing for LPs is control.
The other questions that we also receive is, what are my exit options? So when I invest with you, is my money illiquid? Can I pull out if I need money through the course of the investment?
You can. It's complicated. We're working on a fund that on a diversified fund right now is the DeRosa Group that has liquidity in that, but we don't have it up yet. And most real estate syndications are semi-illiquid. But at the end of the day, you can get out. You just have to sell your shares to somebody else. Somebody like person A that is an LP owner needs to sell their shares to person B who either is in the fund and wants to buy it, or someone who's outside the fund and wants to buy into. And that's typically how shares get sold. Or you got to wait till the property sells or till the syndicator has an event to get you out of the deal.
All right, Matt, this was wonderful for me and my listeners. I appreciated the opportunity for your time and tapping into your wealth of experience. I wish you the best of luck in the North Carolina deal, and if history is any indication, it will be just as successful for you and for your investors. So thank you very much for your time, and good luck.
Thank you, Raj. Look forward to doing it again soon.